some big things happened on relative performance in the last 3 or 4 months. For example, the issue is for an investor, what's a better place to be? It's always the question. And it's always, well, within the S&P, where's the best place to be? But how about thinking beyond that? Maybe gold is a better place to be than the S&P, or gold and related things. Okay. And if you go back after that 2011 peak in gold collapsed in price down to from $1,900 down to $1,050. And its relative performance to the S&P, and this is the first chart that is being put up, it shows the monthly closes of gold plotted as a percent of the price of the S&P. And each month you plot that reading, okay? And when you do, you'll see that there's a trend line, gradual trend line going all the way back to 2014. So like 11, 12 years where you've bumped this line, bumped it. It's a super clear structure, not on a price chart, but on a relative performance chart. Gold broke through that in November. Meaning gold performance broke through this resistance level it had with the S&P, where it had been confined, but basically going sideways for 14 years or so, a dozen or so years. And finally, it punched through this line in November. Well, where was gold in November? $4,200.
Yeah.
Okay. November. Okay, let's start the clock in December because the breakout was the close in November. December, January, now February. 3 months later, we're $1,000 higher in gold net price, and the S&P is unchanged from where it was 3 months ago. Okay, so when these spreads break out, it often does not just signal, oh, one's going to do better than the other. But if the dynamics of that breakout are so clear as this chart is, and it's fresh, you just broke through a dozen-year base that anybody with a crayon could plot the line. You just broke out a few months ago. This is not ending. This is something that's just beginning. And the initial price response to that spread breakout was $1,000 gain in gold, and S&P sitting there kissing itself. Okay? Wow. In other words, the spread breakout yielded a massive price surge. At the same time that happened, there's another spread chart. Well, I want to get to another one first. This is one that hasn't broken out yet. This is the really important one right now as far as I'm concerned about February, March. Okay. XAU index goes back into the 1980s. It's the Gold Silver Miners Index, Philadelphia. Gold Silver Miners Index.
Gold Bug Index or whatever they call it.
XAU. Okay.
Yeah.
And if you plot it in relation to an ounce of gold, divide the price of XAU and an ounce of gold, go back to the 1980s, and you'll see that on the left side of that chart, it oscillated in a range for decades with lows about 17.5% to 18%, meaning XAU would drop down to that relative value to gold, and highs above 30%. So if you look at that range and sort of divide it in half, you'd say, well, it lived on either side of about 25% of an ounce of gold. XAU expresses an ounce of gold. It collapsed in that bear market in 2015, got all the way down to 4%.
Oh,
in other words, the miners used to be worth 25% of an ounce of gold. Then they went to 4%. Okay, now what are they going to do? Go to zero? Okay, right. Screw your head on. Okay. Since then, that spread has lived in a range, perfect little box, for a dozen years plus, with highs at the same level. Every time it goes up to like over 8%, it gets knocked back down a bit. It doesn't go back to that 4% level. No, it didn't. It left that alone, but still lived in a range. You're now with 1 day left in the month. If you close tomorrow where the spread is right now, you're going to break out of that massive spread range. Similar to that line we broke out of, where gold broke out over the S&P. Okay. November, and shot up $1,000. Even in the pullback, it's up $1,000 in price. Not just beating the S&P, but also a surge in gold. Well, here the gold and silver miners relative to gold are saying, I'm back. I'm reborn.
Yeah.
And I'm still at 8.7% of the price of gold compared to lows that were 17, 18%. In other words, when you look at that chart, if you broke out of that base and ran up to the bottom end of the multi-decade prior range of reality,
right,
you'd more than double the current relative value of the gold miners to gold. So wake up. Something's just beginning. You don't break
So
that
this-
spread out and top the market. Okay.
So this breakout, again, we're recording this on Thursday, the 25th. So
Yeah.
after our experience at the end of January, I guess we got to assume anything's possible on Friday. But nonetheless, if just the price of the XAU or just the miners in general relative to gold
Stay where it is right now.
just stays where it is through
Yeah.
Thursday and Friday, so that anybody that's watching this over the weekend can look this up. You're going to have this massive breakout similar to gold versus the S&P at the end of November.
Yeah. No, and therefore, recall what gold did versus S&P when it broke out in November. It wasn't just that it did better since then versus S&P. Gold net price exploded. $1,000 in 3 months. Okay. Even in a pullback, it exploded $1,000 where we are right now. Okay. We're off the high, which was 5,600 area. So this spread is very important to watch now, the gold silver miners versus gold. And then there's another set of charts that also speaks, and it's a table pounder as far as we're concerned. That's silver versus gold. And this chart, top of that page, you'll see that it goes back to 2011. Now, why go back then?
Okay.
Well, 2011 is when silver had that bull market run up to $50 for the second time. Okay. And in April 2011, it reached 50 again, like it was in 1980, and it peaked there. Okay. The spread at that time, which you divide an ounce of silver into an ounce of gold, reached 3.1%. Okay. We don't do the ratio. We just divide it as a spread. Okay. But you'd exploded from 2% or so to 3.1. And then the spread peaked and dropped back down in the subsequent years since 2011. And recently, last year, got below 1% again.
Yeah. I'm doing that. I was thinking the same
silver's going to be free versus gold, I guess. Okay.
Yeah.
It's sort of like the miners versus gold, off the page cheap. Okay. Well, that spread, silver versus gold, broke out through our first breakout level as of the November close. In fact, it went up even further in December. There's another breakout level you can see on that chart. There's two horizontal lines. But at the price of the first breakout on that spread, the November close, silver was $56. Okay. Yeah, we're off the high right now, but where are we? 88 as we're speaking. Okay. So December, January, now into 3 months later, we were at 56 at the November close, and now we're 88. Not only did the spread break out favoring silver over gold, and it surged, the spread did, but silver's price surge was massively more, even with the pullback that we had off the January high. And that spread, in fact, is making a higher high this month than it did last month, despite that pullback. So again, when the spread breaks out, expect price dynamics in that leader category, in this case, in silver. Now, it's our view that this search for new reality in silver is going to get us up to that 300 to 500 zone. Okay. But probably very quickly, because when this spread breaks out, like it just did in November, usually within a couple quarters of that breakout is when you get your gusher, where you go ape on the upside in price.
Yeah.
We're expecting silver to reach that new reality basically by this summer. So another 3 or 4 months. Because usually these spread breakouts, they yield their results within a couple quarters of the breakout. They yield most of their results. And so silver, if it's going to seek a new reality, could easily be back where it was in 2011, 3.1% the price of gold.
Yeah.
Or what about when it was in 1980? It was 6.5% the price. Good grief. Right now we're 1.68 or something. Okay. You could double, triple the price of silver relative to gold just to get to the old highs on the spread. So all these factors are saying sudden, now, and new reality.
Yeah.
And then when we do the silver miners, that's a chart at the bottom of that page, you'll see silver miners are broken out versus gold miners, echoing the breakout of silver versus gold. Conclusion, be in the monetary metals, be more focused in silver and the silver miners.
I'm doing that math in my head. Okay. I mean, the gold chart since the breakout about this time 2 years ago has followed us. I mean, anybody can pull up a weekly chart, just a price chart, and see it. It goes up 20% and goes sideways, goes up 20% and goes sideways. Another 20% takes it to 6,000. 3.1% of 6,000 is 183.
Yeah, well, the gold in its prior bull markets, by the way, it usually doesn't do that layered process all the way. You'll do
Yeah,
that
not interesting.
4 steps up, 2 steps back process during the bull trend, but then suddenly in the latter part of the bull trends that gets you to the new reality, you go more vertical. The behavior changes, which fools people because they're used to the old layered behavior. And they think it's going to, once you've made a high, you're going to stay there for 4, 5, 6 months.
Yeah.
In a range, or you're going to pull back. Don't expect that this time. If gold matches its bull market peaks of 1980, 2011, in terms of the ratio dimension of the bull market from bear low to that bull high, bear low to the bull high, those were both 8-fold moves. Gold's bear market low was 1,050 in 2015. 8 times that says I could go to $8,500 gold just to match the dimensions of the prior 2 bull markets. And what's really curious is that we've had this analysis for quite a few months now. Not saying we're just going to go to 8,000 plus. That's just the norm. I mean, we'll probably go well beyond. Suddenly now some major brokerage firms, big name firms, have come out with similar numbers, saying, hey, we could see $9,200 gold. JP Morgan, I think, just came out with that. Based on certain mathematical relations to monetary degradation and so forth and so on. But, a lot of big firms are now coming out with our numbers for various reasons, which is interesting. But I think that this bull move is now in the acceleration phase, where we're going to get most of what you're going to see, most of the rewards you're going to get if you're long will occur between now and summer.
Michael, what would have to happen? I mean, you've been on this, like you said, since June, reiterating things last year. I remember you talking about, it's going to get to 80 by the end of the year. And I was like, my God, I love you, Michael, but geez. And then here we were. And now, so what, this is all very compelling, and you see the numbers for the metal and you translate that to the miners with their leverage versus their margins. And you think, well, I can certainly see why then the gold shares and the silver shares should be breaking out as well as a ratio. My last question is, what would cause all of this to reverse in your mind to go, you know what, we're going to have to rethink this?
We don't see the technical dynamics for a top. And when we see a top, and by the way, we do call tops in gold. 2011, 3 months off the high, we said, that's it. It's over. Bear market coming. Well, the bear market really didn't start to unfold till 2013.
Right.
We labored off that $1,920 high in late 2011, dropped down. And in December of 2011, we said, we're bearish. And it floundered for a year and then finally crashed.
Okay. Yep.
But there were reasons for that, not just the price chart. There was a momentum structure. When you plotted the annual momentum of gold versus its 36-month average, for example, it oscillated. You had an 8-point uptrend line that you broke. You couldn't see it on a price chart, but on momentum said, God, you just blew the bridge over the River Kwai, man. Okay. And that we said, that's it. You're done. And it took a while to collapse. It finally did. We don't have any such structure set for gold and silver right now. In other words, before you really top and have a major pullback, like silver goes to 500 and then pulls back to 300, let's say, probably you're going to have momentum structures develop, and they're not there now. You haven't even developed the structures. Up under the market, where if you sneeze off the high, you're going to break the structure. Right now, any structures we have that you could break and look at a momentum chart and say, oh, it broke its trend, they're not even near the market.
Got it.
So therefore, we do not think there is any major downturn potential here. That
It's
instead,
not yet, huh?
Yeah. Period.
Well, my friend, you can count me as a fan. I know at my TF Metals Report site, you've got fans galore. And I know Eric, when Eric and I did our year-end wrap-up a couple months ago, he was raving about the job you do. Tell everybody more about momentum structural analysis, where they can find your work.
Well, it's olivermsa.com, olivermsa.com. Ask for some sample copies. We explain our unorthodox methodology there pretty well. It's not what you're used to seeing, normal price chart stuff, and we've been doing it since 1992. So, and we look at all 4 major asset categories. Don't just look at gold and silver, although right now that is our table pounder. That is the asset to focus on.
And I've seen, Michael, in your regular reports, because you put out a weekend report, and then during the week there's stuff that comes out. You point out some of these same anomalies that you see in individual shares as well.
Yeah. So we try to find the outperformers. Anytime a sector is going up or down, there's going to be stocks within the sector that are outperforming the sector and underperforming or par. And what we try to do is every month we sift through most of the mining symbols. We try to define their relative performance to GDX, for example. Which are they doing better than GDX or not? And we plot that and we technically analyze it. And so there are always going to be miners that beat GDX on the upside. And that's where you'd like to prefer to pick the better ones. Although frankly, right now, I think you could throw a dart at the whole sector and come away smiling big time in 3 to 4 months. So
I can sure see how it all connects. Like you said, if the metals are going to keep going and those margins just getting
the
better
miners
and
are back to their highs.
Then why wouldn't
notice
they?
that?
Yeah, right.
The silver miners are back to their highs. Gold miners back to their highs. So the miners have suddenly said, "Hey, we're leaders now. We're not followers, and we're underpriced relative to that which we get out of the ground."
Yep. Fascinating stuff, Michael. Like I said, when Michael Oliver talks, people listen. Hopefully you've been listening, my dear reader, and that you flag this and go back and listen a couple of different times. Obviously, thank you, Michael. We've reached the end of February. I can't even, we're already a sixth of the way through the year. They say time speeds up as you get older, Michael. You agree with that?
Oh, yeah. And sometimes things get really good. This is a major event we're looking at here in the monetary metals. This is a lifetime event.